Welcome everybody to this webinar that is brought to you by Bursa Malaysia and managed by our company LifeCham. My name is Shinju. I'm the moderator for this session. And today our webinar title is A Systematic Way to Build Your Watch List. Now, having a watch list is very important so that we know what are the stocks that we are interested in, that we can closely monitor their performance over the period and try to find an opportunity for us to buy into the stock. So today, our speaker is going to share with us what is her strategy to build a watch list. Right. So before we begin, as usual, disclaimer. Next slide, please. Whatever we share in this webinar is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. All right, so allow me to briefly introduce our speaker. And she's none other than Ms. Tang Wai Ying. Now, Wai Ying began her career at RHB Investment Bank. She has spent 9 years in the financial services industry while obtaining a dual license, which specializes mainly in listed derivative and also the equities market. So with over 6 years experience and not less than 80 sessions conducted, she has trained more than 500 people in her training that she had conducted. She also regularly attends annual general meetings and also company visit for different listed companies to keep her clients informed about the latest updates during her sharing session. She graduated with a bachelor's degree in banking and finance from Sheffield Hallam University. So welcome to our webinar today, Wai Ying. How are you today?
Oh, hi everyone. Good evening, everyone.
All right, fantastic.
Oh,
so
yeah.
I can't wait
So
to
we
learn from
we
you.
have to begin the session 10 minutes earlier, probably. Yeah.
Yes, you can
Okay.
go ahead.
Okay. All right. Okay. Good evening, everyone. Thanks for joining me on today's session. My name is Wai Yin. I would like to have a brief introduction on myself before I start today's session. For those who join me before, please pardon me, okay? I have nearly 10 years experience in the industry. Unfortunately, the market never goes up because the moment I join is the red color box over here. Working with clients in the stocks and futures market has helped me to quickly accelerate my learning curve in investing and trading. At the same time, attending AGM and corporate visit let me stay up to date with the company's operations, with their financial performance, and also the company future plans. This exposure also provides me the opportunity to network with other investors, analysts, and company representatives. Usually after our company visits, we will post our writes-up on our Facebook and Instagram pages. And recently, we do have our WordPress page as well. If you are interested, please feel free to check out our social media pages, and my partner will share the link of the social media in the chat box for you all. Okay, the topic for today is a systematic way to build your watch list. A watch list is a collection of stocks that we monitor. Since we have limited time and attention, a well-organized watch list can help us to identify trading or investment opportunity. We can even create multiple watch lists for different trading or investment strategies. For example, I maintain a watch list for long-term investment stocks. Inside the watch list includes companies like Public Bank or Bursa Malaysia. And I have another watch list, which is my swing trading watch list. It consists of the stocks that is currently in a correction, but still trading in an uptrend. And another watch list for me will be a goreng watch list, include the day by day most active stocks, as you may know. So that will be in my watch list for my goreng watch list. Today, I will be sharing how we use a systematic approach to conduct our watch list of quality stocks for long-term investment. Let's say your friend will invite you to become a shareholder in their existing business, what are the questions that come to mind? Anyone know? You all can leave in the chat room. Leave your answer in the chat room. If someone asks you to join their business, and then what will you want to ask to know from them? PE ratio, profits. All right. How good the opportunity? Yeah, can make money or not, right? Okay, now, first of all, we would want to know what kind of business they are going to run, right? And is the business currently generating any income? If not, is there a strong growth strategy in place that would make it profitable in the futures? And what are the plans for them to increase their sales and profits in the futures? And I will be wondering, can the company meet its debt obligation or not? Additionally, we would like to know how much the director would want to take from the company as their salary, and what is the selling price for this business, right? So basically, this is how we examine a business. And most investors from the S&P 500 research over here, most investors underperform the market over the long term. According to the S&P, fewer than 10% of the US equity funds and just over 10% of international equity funds manage to beat their benchmark over a 15 to 20 years horizon. Does this mean that we should abandon the practice of stock picking altogether? Not necessarily. Yeah. Since every stocks represent a stake in a real company, it's logical to invest in high quality company. Time has shown that one of the best investment approaches is to focus on quality. Consider the MSCI World Quality Index. It outperformed the MSCI World Index by 3.45% per year since 1994 by identifying stock with high quality scores based on three fundamental variables, which is high return on equity, stable year-over-year earnings growth, and low financial leverage. For example, in a Malaysia market, we have nearly 1,000 stocks. There are around 200 to 300 stocks have double-digit return on equity. Out of these 200 to 300 stocks, perhaps we only have a deep understanding of some, but definitely not every single one of the company. And we need to find out what is the sustainable competitive advantage within these 200 to 300 company. And it would be ideal if these company are currently trading at attractive valuation. In short, we use quantitative model to screen for stocks with a good quality scores. We then study the business and then try to figure out the right price to pay for the company. By concentrating on stock that check all the boxes, we can potentially enhance our investment strategy and increase our chances of success. Now, why do we need a watch list? Imagine logging into our trading platform every day, and the most active stocks constantly change. If we had to study each stock every day, because every day the most active stock is changing, so you have to study each day, it would become a time-consuming and slow down your decision-making process. That's why we use the watchlist feature on the trading platform, and then it helps us easily keep an eye on the stock movement, so we can quickly respond when there are signals to enter or to trade. At the same time, Owning a watch list can improve your time efficient compared to constantly searching for new investment opportunity or monitoring a large number of stocks. Efficient monitoring also allows us to monitor the performance of the stocks that we are interested in and stay up to date with their news, earnings report, and other relevant information that may impact the movement of the stock price. One of the benefits of creating multiple watch lists with different strategies is that we can test the concept and ideas. For example, if investing in all the stocks in our watch list for a certain strategy can outperform the market, then if we refine our selection based on qualitative criteria, might further enhance the performance of the strategy. The reason we focus on high quality company is because this strategy tends to have a lowest turnover, aligning with the long-term investing concept. However, when focusing on the value stocks, we need to sell them when they reach their fair value and replace them with the other value stocks. From my experience, good companies like Hermes, they can remain overvalued for an extended period. You see, most of the time it stay above the red color fair value price. So it can stay extended period of time. For example, 20 years ago, most people here probably experienced the old school way of browsing the internet by opening Internet Explorer and use Yahoo as the search engine, because Google Chrome didn't exist back then. However, at some point, the search engine trend changed from Yahoo to Google, and people started using Google more often. It's quite evident that Google search engine market share began to rise and surpass Yahoo starting in year 2003, which you can see over here. Ever since then, Google has become the trendy term when people want to search for something instead of saying Yahoo it. So company experiencing circular growth and possessing strong competitiveness tend to exhibit a robust upward trend. As long as it is a leader in the industry, it often maintains that position for a substantial duration until another company appears and takes over the market shares. As we all know, Google has been a quality company for the past 20 years, and it remains as quality as a quality company today. So can you think of any company in Malaysia that has remained their quality for many years? You all can share in the chat box. What is the company in Malaysia that you all can think of that remain as a quality company for many years? Maybank, Public Bank, PBB. Oh yeah, Nestle, Batu Kawan Tenaga. All right. Okay, now this is the performance of the watch list of quality company in Malaysia that we have maintained for the past 15 years. Besides tracking the past performance, it also enables us to monitor changes in the stocks over time. For example, let me share with you the other screen. Yeah, okay, never mind. For example, in year 2007, the watch list contained a significant number of plantation stocks, which is here. However, starting in year 2015, during 2007 here, there is no technology sector yet. No stocks fulfill the criteria yet. So there is no technology stocks here. And when it comes to year 2015, we begin to see more tech stocks, which is here, added to the watch list. And now, today, even more tech stocks meet the quality score criteria. When more and more companies in a specific sector achieve the quality scores, it can indicate industry growth and helps us identify which sector we should focus on. Now, although we might miss the initial movement of these stocks like Inari, paying attention to them when they start to exhibit the quality can still yield good result. So maybe we just realized this company during 2016 or 2017, we missed the front part, but we still can yield a good return. Even for Vitrox, same thing also. If we miss the front part, but we still can yield decent return from here, 2016 and 17 here. Okay? So by comparing the performance of the stocks on the watch list to the overall stock market performance, we can determine whether a certain concept has a statistical advantage over time. If we can select a better company from different sectors on the watch list, it may provide enough diversification and even the performance. Now let's take a look at the research done by this MSCI. The result is very clear-cut. Higher quality significantly outperform lower quality over the past 2 decades. Lower quality is the blue line, higher quality is the yellow line. Equally important, they had a lower realized volatility. This outperformance span both the value and growth divide and the 3 different market regions, USA, world exclude USA, and emerging market. Most relevant to current condition, MSCI found that higher quality firms were especially resilient during the period of market stress, such as during 1998 Russian sovereign default, 9/11 attacks, and also 2003 Iraq invasion. This table shows that historical likelihood of a firm transitioning from one quality class to another a decade later, perhaps due to their wide economic moats or solid balance sheet. 75% of the firm that begin as high quality remains that way. In contrast, only a third of the lower quality firm were able to cross the gap to higher quality range after a decade. In a study by GMO, it's clear that good sectors and businesses remain good and poor return businesses also have persistently poor returns. This happens because strong businesses find way to beat the competition. Warren Buffett called this moat. Poor return also persists because these companies have too much competition and no control over prices or costs. In Malaysia, there are good and high quality companies that generally have the potential to outperform the market. For instance, during the pandemic time, the KLCI, the bottom chart, dropped to its 2010 level, year 2010 level, but some of the stocks remain significantly higher. For example, like this Vitrox, Heineken Malaysia, Apex Healthcare, Timecom, Public Bank, Uchitech, and United Plantation. Some high quality stocks can stay on our watch list for many, many years. For example, let me share with you this Excel sheet. Okay, you all can see during the year 2008, Heineken remained in our watch list. Okay, has been in our watch list since 2008, and even until today, 2023, Heineken Malaysia still remain in our watch list. Maybe we use tech stocks, which happened on year 2012. Tech stock Vitrox is included in our watch list since 2012. And this company remain in our watch list until today. This is a 2023 Vitrox other technology sector. We only remove a stock from the watch list when it begins or no longer to meet our criteria. Okay? Okay. All right. And in order to determine whether a company passes our quality score or not, we assess 4 quantitative criteria. We seek a company with history of growth and the potential for future growth. It should maintain a good return on capital for not just 1 year, but for at least a few consecutive years. Lastly, it should demonstrate a strong financial health. In general, if a company's growth rate is slower than Malaysia economy, it may not be a strong business for long-term investment. We will use Malaysia GDP as the benchmark for the company growth rate. And then it may be a candidate for a turnaround, cyclical, or goreng-goreng play for the company that doesn't meet the growth rate of the what we set on the criteria. And then for stock with analyst coverage, we will also look at the forecast as a reference for futures growth. Unlike the research report in the developed country, forecasts for Malaysia stocks typically extend only 2 to 3 years into the futures. And it's important to note that these forecasts may not always be accurate. If you were given the opportunity to run a business, what percentage of return would you consider fair or reasonable to compensate for the risk involved in running the business? Would it be 8% or 10%? Now, what if the business return is around 3 to 4%, nearly equivalent to the FD rate, which is current FD rate? Would you still want to continue running the business, which means put your money to run the business? Probably no, right? Might as well you put in a risk-free rate product. Now, according to research from year 2017, the S&P 500 market had an annual return on equity of 13.7%, whereas the average return on equity for Malaysia stocks hovers around 7%. In theory, it's ideal to invest in a company with a return on equity higher than average. Okay? Few years ago, we have done a back test on Malaysia stock market from year 2001 to year 2016, which is a 16 years back test. The first group of stocks here are profitable business with profit more than 0. And the second group of stocks, which is here, here, are the stock of a loss-making business company with profit less than 0. It is an equally weighted portfolio and rebalanced every year. This backtest reveals that the stock with profit more than 0 outperform the stocks with profit less than 0 and also outperform the KLCI index. The group of the company that have profit more than 0 have a cumulative return of 410%, annualized at 11% per year, which outperformed the KLCI return around 5.7%. It shows that in the event that we cannot predict the earnings, the company futures earnings, statistically, it is better to invest in the profitable businesses than a loss-making businesses. In another backtest, the first group of stocks with return on equity more than 10% and the second group of stocks with return on equity less than 10%. It is also an equally weighted portfolio and rebalanced every year end. It appears that the stocks with return on equity more than 10% outperform the stocks with return on equity less than 10% and also outperform the KLCI index. For the group of businesses that have return of equity more than 10%, generated a cumulative return of 650% annualized at 13.4%. And compared to the KLCI 5.68%, is very good already. Huh? In this event, we could not predict the earnings. So it is better to invest in company with high return on equity. Generally, we prefer company that generate high ROE through high profit margin or asset turnover than the company that use high leverage. Let's take a step further and look at this. Company with net cash plus ROE more than 10% with only ROE more than 10% company. The cumulative return for the net cash plus ROE more than 10% had generated a 830% cumulative return, which is annualized around 15%, and purely on the ROE more than 10% group have generated 650% only. From the examples here, it shows that even a simple fundamental formula such as ROE does give investors an edge in investing, right? We typically find interest coverage ratio in the range of 8 to 10 times to be acceptable. It's important to note that there is no one size fits all the answer, and some of the investors may be comfortable with ratios in the range within 3 times to 5 times. Ultimately, the acceptability of this ratio depends on individual risk tolerance and individual judgment as well. Another ratio to consider is the net debt over EBITDA ratio, which is generally considered quite safe if it is less than 5 times. Okay, now these are the website we use for our stock research. The first one is a KLSE Screener, and then Stratosphere, Malaysia Stockbiz, and also Bursa Marketplace. Today, I'll walk you through how to find high quality stocks systematically. Remember, the approach can be different if you are looking for growth stocks, value stocks, or small cap stocks. Feel free to experiment yourself with different methods, and they are definitely quite interesting, okay? I'll guide you through the process of screening and creating a watch list from a few Malaysia market sector, which is from the consumer product and services, financial services, healthcare, industrial product services, and technology sectors. Let's begin with the consumer product and services sector. Can you see now I'm at the KLSE Screener page? Can I? Okay, so I'll be starting from the consumer product and services sector. So first of all, we will come to here, and from here we choose main board, and the sector we will choose consumer product and services. Then we scroll down to screen. Oh, Sorry, it's a bit, okay. So there are around more than 170 companies in the consumer sector. Then I will be screening from the market cap. So I'll come to the market cap. I'll choose the company from the largest market cap to the lowest market cap. I rank like that, okay? And we will first notice the first company here is a Nestle with a market cap of close to 30 billion. So because today I'm just demonstrating this, so I won't be covering all the 173 counters over here. I will just share with you all the top 10 company in the list with the largest market cap, and I'll just go through with this for each of the sector, okay? So I believe most of you know Nestle product, which is like Nescafe, Milo, Maggi, Kit Kat, and so on. And if you realize, under consumer product and services, they have their subcategory as well. You can see Nestle is under food and beverage, Petronas Dagangan retailers, and then you have travel, leisure, and hospitality, automotive, and agricultural product. So if you want to have a better choice of subcategory, you can categorize them, and then you start from the subcategory also can. But I'll just directly use with the largest market cap today. So Nestle, we all know their product. And next one, we have Petronas Dagangan, which owns the Petronas station. PPB, a diversified conglomerate founded by Robert Kwok. And PPB is the largest shareholder in Wilmar, a plantation company listed in Singapore. It also owns GSC, the largest cinema chain in Malaysia, and engaged in business like selling Massimo bread. Then there is Genting and Genting Malaysia. I believe most of you know these two companies, which need no introduction. Sime Darby operate in core businesses serving industrial, motors, logistics, healthcare, and insurance sectors. Whereas for Mr. DIY is a Malaysia-based home improvement retailer. QL Resources is the owner of a Family Mart in Malaysia. F&N, famous for their Sasi and 100 Plus. Lastly, there's Heineken, one of the 2 alcohol company in Malaysia. Now, let me use the largest company here, which is Nestle. We will use Nestle to determine if it is a quality company by assessing its growth, profitability, stability, and the financial health. So we will use the Malaysia Stockbase website, which is here, and then we will go to Nestle. Sorry, internet a bit lag. Yeah, Nestle. Then we will scroll down. And then we will come to here, financial highlight. We choose annual. We can quickly examine Nestle's annual revenue and earning growth here. And the margin level weakened during the pandemic, which is over here. Financial year 2020, 21, and 22 over here. This is because the pandemic period, overall, we can observe a steady revenue growth, the orange color one. Okay, so for the revenue growth, okay, then we will go to the stratosphere page. And then from here, we will look for Nestle Malaysia. Okay. We can see that the revenue has grown more than 5% over the past 5 years here, and almost 4% over the past 10 years. Additionally, the earnings per share for the next 2 years or in the long term are expected to grow at a 9.9% in the next few years. Maybe you feel adopt about this forecast, you can always double confirm. Then you can go to the page called Bursa Marketplace. And then you can search for Nestle. You can always refer to the analyst consensus over here or the research report. So I will choose the analyst consensus. And you can see that there are analyst recommendation. So how many analysts recommend to buy, to hold, to reduce, or to sell? But what I'm trying to share with you all today is the EPS growth from Malaysia stock list. The EPS is projected to increase from 3.05 in year 2023 to 3.61 in year 2025. So Nestle has been growing and seems likely to continue growing, although at a slower pace in the future. So on the growth criteria, it passed already. So let's come back to the stratosphere page. We can see here for the returns over here, Nestle has maintained a high return on capital for the past 5 years with decent margin as well, which is here 30%. Its interest coverage ratio, we can scroll down to the ratio here, choose financial health, and you can refer to this EBITDA divided by interest expenses. We can notice that the interest coverage ratio exceeds 30 times, indicating strong financial health. Therefore, we can conclude that Nestle is a quality company. So this is how we usually screen the stocks and the steps with different pages involved. Okay? So I won't be demonstrating all of the company. I'll demonstrating few from each sector only. Okay, so this is the few pages that we will be using. Okay, now Sime Darby. Sime Darby has been able to grow its revenue and earnings since 2018. The orange color bar, you see. This is the page from Malaysia Stock List. It currently shows a negative 2 years expected growth and 4.5% long-term earnings per share growth. It sends a mixed signal to us. And if we take a look at other information, its return on capital is not impressive, it's around 5%, and it has a low margin. Even the research from Maybank, you can see the interest coverage ratio here, which is the purple color line, is quite volatile. Okay, but the growth of the return on capital is not impressive lah. So we will be excluding this, but you can refer to the research from Maybank. It shows a low earnings per share growth in the next 2 years. Therefore, it's safe to assume that Sime Darby may not be a quality company. As for Genting, it failed to generate profit due to the pandemic, which is around here. Financial year 20 and financial year 21, financial year 22, which should be a temporary issue. It appears to have been growing steadily before the pandemic. According to the research report from Maybank, there is a chance for Genting profit, which is here, to exceed the 2019 level of 2 billion again. Come back again. You can see the profit during financial year 2019 is around 2 billion. And Maybank forecasted that their net profit will exceed 2 billion again in financial year 2025. However, its return on capital has been weak before the pandemic. You can see here, return on capital is the red color one. Even before the pandemic, it's not impressive. So Genting will not be included in the watch list. After we repeat this process for the top 10 company in the consumer sector, there are 6 out of 10 stocks pass the quality test. And we will next move to a technology sector. So I will share with you all again the steps on the technology sector. All right, we will come back to the KLSE screener page, and then we will go to main market and we choose technology, then we screen. Same thing, we will go with the company with the top 10 largest market cap. The first company here is Inari. I think most of you know Inari is a leading Malaysian technology company specializing in semicon manufacturing and electronics. They are renowned for their expertise in producing advanced radio frequency product and semicon component. Okay, so we will come to the Malaysia stock bid page. Then repeat again, we will search for the company Inari. Okay, so you come to the financial highlights and then you choose annual. You choose annual. And then you can see, because semicon industry is experiencing a circular growth trend, Inari has tripled its earnings over the 9 years, which is from 100 million to 300 million over here. And then we can come to the page of Stratosphere to look for their profitability. Okay. On top of that, both revenue and earnings are expected to grow impressively for the next 2 years, which is around 18% from here. You can see, And on the return wise, the return on capital and margin have been outstanding for the past 5 years. Return on capital more than 30% and gross margin also 26%. With 1.8 billion in net cash on hand, the company boasts a solid balance sheet. It is, without a doubt, a quality company. So it will be included in our watch list. And the same goes to Vitrox. Vitrox. It is a company that had been in our quality list for over 10 years. This is a net cash company with impressive growth. You can see the orange color bar, and has maintained a high return on capital, almost 50%, and margin 67% for many years. So definitely this is a quality company and will be included in our watch list as well. So if I put it in a chart way, you can see the return on capital, the dark blue color, and the ROE is quite good over the past 6 years. Okay. And MyEG. MyEG, it actually experienced a revenue spike in year 2021 and year 2022 due to the segmental revenue from the COVID health screening and setting up the quarantine centers. However, in the quarter 4 financial year 2022, here, the government lifted the health screening and quarantine requirement compared to quarter 4 financial year 2021. MyEG revenue was affected from 700 million to 650 million. The government also closed its quarantine center and allowed private quarantine arrangement. Despite the cessation of the revenue from COVID health screening and quarantine center, MyEG forward earnings per share, which is around 8.5% for the next 2 years, and high return on equity, high return on capital, almost 30%, return on equity, almost 30%, and margin of around 80%, with a healthy balance sheet, which is the interest coverage ratio around 25 times, it still meets our stock screening criteria. Therefore, my EG will be included in our list. So in the end, after screening the 10 technology company with the largest market cap in the technology sector, there are 7 out of 10 largest stocks in the technology sector that pass the quality test. Okay, then we will come to industrial product. I'll be sharing again on the steps on how to screen. Okay, so we will come back and we will go to industrial product and services, and then we screen. Same thing, go with the company with the largest market cap. Okay, the first company is Petronas Chemical. They have a subcategory in different as well. So if you want, you can go with the subcategory, okay? Then you can come to this Malaysia stock list to look for their revenue growth. So every sector, you will just repeat these steps within these few pages only. So we will come to the annual. Petronas Chemical has been growing, and earnings are expected to drop in the next few years. And to have a better understanding, maybe you can refer to research report on why there is a drop. So you can come to Bursa Marketplace again, and then you search for Petronas Chemical. Then you go to research. You scroll down. You have the Maybank research, the latest one, and then you can download. Cannot be shown. Okay, one moment. I have a backup. Okay. Okay, for Petronas Chemical, because the page cannot be loaded, and I have backup over here. If we refer to the research report by Maybank, its net profit is the net profit over here. I draw the net profit over here, projected to decrease from 6.4 billion from year 2022 to 5 billion in year 2025. So it doesn't meet the growth score. Therefore, it will not be included in our list. Okay. So if we back to the page from Stratosphere, it also shows that the earnings per share for the next 2 years is a negative 22%. Therefore, it fails to meet the first criteria, and we will not include this company in the watch list under industrial product and services. Okay. Okay. Then we will come back to the next company in the list, which is second company, P Metal. P Metal is a Malaysian-based aluminium group with an extensive global presence. It has a downstream extrusion operation that is integrated with its greenfield aluminium smelting plant in Muka and Samalaju in Sarawak State, which have an annual combined capacity of more than 1 million tons. P Metal also operates aluminium extrusion plant in Malaysia and China market. An increase in aluminium prices and the USD typically benefits P Metal. The demand for aluminium has been rising over the years. You can see from the yellow color line over here, the demand is increasing. And P Metal has expanded its production capacity, resulting in increased revenue and earnings. You can see there's a spike over here. And P Metal revenue is highly dependent on aluminium prices. While aluminium prices have traded between USD 1,005 and USD 3,000 range for the past 20 years, it's evident that P Metal lacks strong pricing power, for example, like Lovestock. However, today we are actually focusing on the quantitative aspect and the numbers over here. The growth for the next 2 years is around 6.5%. The return on capital 11%, ROE 16%, margin around 17%. With the purple color line, the interest coverage ratio looking good, which is around 10 times. Therefore, we consider P Metal as an acceptable quality company, so this will be included in our list. Whereas for Malaysia Cement, over the 10 years period of time, it has only been 6 profitable years out of 10 years. You can see the blue one, there's only 6 profit years, and this 4 years is experiencing losses. So it looks like it is a cyclical stock. So this will be excluded. Even if you look at the stratosphere expected growth, they have a 82.6%, but the return on capital and return on equity does not meet the criteria as well. So it will not be in the list. In the end, there are 3 out of 10 largest company in industrial sector we screen, and only 3 meets the criteria and included in the list. All right. Next is the financial services. So same thing, we will go to the page KLSE screener, and then we will go to financial services, then we screen. Okay, so we will go with the company. Okay, main market, financial services, and then we screen with the company with the largest market cap. The first company is Maybank. And then you can see most of the list of the subsector here is banking. Only Bursa and MBSP is other financial. So maybe I share with you all on the MBank. So let's say we come to here and we look for MBank. Malaysia Stock Biz page. And then we scroll down to annual. As you can see, for the past 10 years, their revenue considered stagnant. steady and start to drop with these recent years. And we can go to the page called Stratosphere to further justify this drop. So the growth for mBank in the next 2 years is around 1% only, and the return on capital also falls at 1%. Therefore, mBank is not qualified and it won't be included in our watch list. Okay, the first criteria already doesn't meet the growth criteria. And then we'll come to Bursa. Over the years, even though Bursa growth were not impressive, as it depends on the trading activity, but it has consistently achieved a high return on capital and margin, which is over here, return on capital almost 50%, margin around 98%. The spike in year 2020 and 21, which is here, the trading volume here, was due to the increase in trading volume in the market during the pandemic year. According to Warren Buffett, favorite holding period is forever. It seems to have fallen out of favor in recent time. There is an analysis from New York Stock Exchange data by Reuters reveals that the average holding period for the US stocks is 5.5 months. In contrast, investors in the 1950, typically they will hold on their shares for an average of 8 years. The rise of the online trading platform makes it convenient for investors to buy and sell stocks anytime, anywhere. Moreover, the availability of the lower brokerage fee for stock trades provide an additional incentive for investors to engage in a more frequent buying and selling activity. These trends are favorable for stock exchanges. Therefore, Bursa will be included in our watch list. Okay, after screening the top 10 company, there are 7 counter that qualify in the qualities criteria. Then this is the company that we will include in our financial service watch list. Next will be on healthcare. Same thing. We will go to the KLSE screener page. And then we will go to healthcare. All right. Then we screen. There are around 18 stocks in the healthcare, 18 stocks over here. We will go with the company. This is the company with the top 10 largest market cap. And they have 3 different subcategories: healthcare provider, healthcare equipment and services, and pharmaceutical. So most of it, you can see, is a glove stock. So let me use Top Glove as the example. Come to here and annual. Top Glove and other glove company has experienced declining growth in both sales volume and the average selling price. The company performance slipped into the red, which is here, has significantly impacted its share price. As it has begun to incur losses, they will not be included in the list until the outlook is improved. Okay, so the first growth already doesn't meet, then glove sector will not be included. But one thing quite important, you all can take note. According to research from Kenanga, the outlook for glove company remain challenging due to oversupply and the low average selling price. The situation will only improve when there is no new capacity coming on stream. Magma projects 12 to 15% growth in the global demand for rubber glove annually from year 2023 to year 2026 here. The demand is expected to exceed supply in year 2026. So by that time, only the price will have slight changes probably. And we will go to the pharmaceutical company under healthcare. D Pharma and Apex Healthcare, both these company revenue and earning have been steadily growing over the years. You can see the orange color bar and expected to continue growing. They also have decent return on capital, which is here 8%, return on equity 10%, margin around 40%, and a healthy balance sheet. They have a stable interest coverage ratio. Therefore, these pharmaceutical company are included in our list. Therefore, a watch list from these 5 sectors is formed. This is the company that pass our quality criteria one. And take note that the stocks included in this watch list is the stocks that meet our quality criteria. However, the exclusion of these stocks from the watch list doesn't mean that they are bad investment. They may be more suitable for value, for cyclical, for turnaround play, or trading. Our primary goal is to hold stocks that can compound their earnings for many, many years. This strategy allows us to be right once and keep adding to our position when the opportunity arises. As I mentioned just now, for simplicity, I selected the top 10 company with the largest market cap in each sector and went through the screening process. There will be more stock in the list if we consider all the company in each sector. And now, it may not be a good idea for me to buy all these 26 stocks in my watch list. So I will usually pick 1 or 2 stocks from each sector that I believe it have the potential to continue growing and for diversification purpose as well. So every time when the market experiences a correction or stocks valuation become cheaper, I will start buying stocks from my watch list. Wow, it's tempting to allocate majority of the fund into the stock with the cheapest valuation. Experience has shown that they may not always perform as expected. Good company can remain overvalued, like just now the Hermes, for an extended period. As discussed in the previous session, for the allocation model, I am more comfortable with an equal distribution allocation among my investment. So I have only 9 counters in my portfolio, so I'll allocate 10% each, and the remaining 10% will be my cash on hand. Okay? And there are no standardized criteria for stock selection. Each sector has its unique criteria. When evaluating a company's past growth rate, it's important to recognize that it is highly dependent on the economic situation at the time. We take Heineken as example. Over the past 5 years, their revenue growth declined during the COVID year, which is over here, financial year 2021 here. If we assess the company within this reason here, there is a significant, drop. You all can see a negative growth here. And we might conclude that Heineken has negative growth, which could lead to an incorrect assessment. During that time, Heineken was actually facing the challenges posed by the COVID-19, which should be a temporary issue. And it seems that Heineken's revenue and earnings are continuing its growth now. As I mentioned just now, each sector has a different growth rate, so we can't apply standard numbers to all sectors. For the consumer staples and financial sector, as long as they can match Malaysia GDP growth rate, it's considered reasonable. And for the tech stocks, we definitely prefer a higher growth rate. For example, in the financial sector, the return on asset and return on invested capital tend to be lower, which is around 1 to 2%, because financial institutions often use leverage to magnify their returns. Whereas for companies like Costco and Walmart, both of them operate on a distributor or retail business model, focused on low margin, high sales strategy. These two companies do have some different. For example, Costco makes some of its profit from the merchandise, but the bulk of its profit comes from the membership deals. Only members can shop at Costco and mark up their product price around 14 to 15%. Thus, it often has low profit margin on individual product, but make up for it through high sales volume. And actually, we are not keen on low margin businesses. Therefore, we might be missing out on this company. You can see Costco growth exceeded Walmart and S&P 500 for the past 10 years. There is always an exceptional case. If you are interested on this industry or the business model, you can include this kind of business in your watch list. And if we extended the period of comparison for 30 years, Costco has a compounded annual growth rate of 16%, outperform S&P 500 by more than 5% per year. So it's very impressive return, okay? Now, after all the theory and discussion of financial metrics, what would you do if we are actually discussing Amazon? If you were given the chance to go back 10 years ago, would you choose to invest in Amazon? Even though its financial numbers were poor during that period, you can see their gross margin is very low, and the return on equity also there's negative, then 3%, 4%. Return on invested capital also very low. I believe most of you at that time, you all won't choose to invest this company, but today you will say yes to this company. And actually, Amazon may not qualify as a quality company. It has consistently achieved high revenue growth, making it a growth stock that require different analysis and investment strategy. Amazon has grown its revenue at more than 23% annually for the past 10 years. And interestingly, its share price has also compounded at almost 23% over the same period. Whereas for Netflix, it has grown its revenue at around 23% annually for the past 10 years, and its share price compounded at more than 24% at the same period of time. Although stock prices can be volatile, it's clear that in the long run, they track business performance. For high growth company in this scenario, the revenue growth. Hopefully, I'll get to share with you all more about the growth investing strategy next time. Okay? While a monopoly position may give a company a strong moat and strong pricing power, consider Tenaga as an example. If we have invested in Tenaga since year 1992, the annual return would be only 4.4%, which is here, about the annual growth 4.4%. Despite its monopoly position in Malaysia, the stock price fails to accurately reflect the monopolistic status. Even as household electricity usage increased, the stock price did not react accordingly, as Tenaga cannot simply raise the electricity prices. If the return on investment can barely beat FD rate, wouldn't it be better to place the fund in an FD than investing in this business? Therefore, no point for us to risk our fund in an investment portfolio that cannot outperform a risk-free product, right? Industry with circular growth is the industry we are looking at for long-term investment. On the flip side, there are industries in decline, commonly known as the sunset industry. To minimize risk, it's wise to avoid investing in them. As we know, not all industries are suitable for a buy and hold approach. Some industry like real estate or oil and gas operates in a cyclical pattern. As a result, these cyclical industries tend to be more suitable for trading rather than the long-term holding. According to Michael E. Porter, has established this research and ranked each industry based on their profitability level. Industry that consistently produce the highest return on invested capital consistently hold the top position. Businesses that have pricing power had significant advantages compared to others. Industry with strong pricing power can enjoy advantage such as higher profit margin, greater control over their profitability, and insulation from intense price competition. As a result, industries with high gross margin tend to have high pricing power. Okay, we are in the last part of today's topic, lifetime trading age. Okay. To be honest, trading can be emotionally challenging, especially when you need to work on mastering emotions like greed and fear. Therefore, continue to learn mindfulness to stay focused and avoid making emotional decisions is the key to a lifetime trading age. Market evolve, new technologies emerge, economic change serve as motivation for investors to engage in the continuous learning environment. This is a lifelong process. And at the same time, develop a well-defined trading plan that include all aspects to avoid impulsive decision. Journal record is one of the important ages as well. Maintaining a detailed trading journal to track your trades, your strategies, and outcomes is very important. As always, backtesting helps identify which strategy have historically been profitable and which one are more suitable for the characteristics of the respective individual. In determining the position size based on risk tolerance and the volatility of the product in trading is important to avoid over leveraging, as it can lead to a significant losses. Over trading can also lead to substantial losses. Stick to the trading plan and only you take action when there is a clear and well-reasoned opportunity. Extending the time frame is advantage for investors because investors doesn't work like a fund manager. They don't have to report to own self every quarter or every year like those fund managers do. It allows investors to have more time to validate their investment performance. Okay, this is the lifetime trading age. And a quick recap for today. For successful investing, business is more important than the share price, and we will prefer to choose the business that have this circle of competence, which means invest in what we know, and the strategy is to buy, hold, and resell. We don't need to monitor closely, and we just need to operate like an index without emotions with discipline. Okay, so always follow your own investing strategy. This is the strategy of ours, which is always focus on high quality businesses, invest regularly, and build a diversified portfolio. Okay, and that's all of my presentation today. Thank you very much.
Thank you so much, Wayne, for sharing with us your criteria in stock picking and also your systematic way to build a watch list. I'm sure you all have learned a thing or two from Wai Ying today. So if you have any questions to ask Wai Ying, we have less than 10 minutes to do a question and answer session. So you may write your questions in the Q&A box. So don't write them at the chat box, yeah? So if you write them in the chat box, maybe all the messages will, there are too many messages coming in. You may get swamped that I may overlook your question. So write them in the Q&A box so I can easily manage your question. Okay, will there be a recording for this webinar? Yes. Of course, we will send you the recording tomorrow via your registered email. So you can click on this the link tomorrow via your registered email to for the replay. So the first question is by Edmund. How do you calculate the valuation of a company? For example, let's say Nestle.
One moment.
Why?
Yeah.
Yes, yes. Your webcam went off.
One moment.
Okay, sure.
It's quite lag. Wait.
All right, it's quite lag on the side, is it?
Yeah.
No worries. If your internet connectivity is a bit more laggy, then you may turn off your video camera to save the bandwidth.
Yeah, correct.
All right, so you just
yeah.
answer it.
So basically for Nestle, this kind of company, they have a steady growth already. So most of the people will prefer to use discounted cash flow method analysis, or they will use the steady growth rate just to compare their return on capital. As long as it the result remain the same and didn't have significant move, then basically we will continue be holding Nestle, this company.
So what would be your valuation criteria? Like, does it have to fall below certain P, or has it got to be above certain P ratio, or do you only buy when the intrinsic value is above the market price? So can you share with us what is your criteria?
The criteria is as long as the company can maintain their profitability and stability of their returns, then it will be maintained in our portfolio. I won't be going into the, like just now what you mentioned.
So the valuation aspect is not a big consideration, am I right? In comparison to profitability and the growth rate.
Yes, as long as they have a steady profitability and they didn't go below what is in the previous history, then it will be included in our watch list. Our portfolio.
Yeah, like many retail investor, we may not be familiar with discounted cash flow methodology. What would you recommend that retail investor like us to evaluate the valuation of a company?
I think we don't need to do it ourselves. From the Bursa Marketplace page, the research analysts already done their job, so we just need to follow what they uploaded there, so we can save a lot of work from there. Yeah, we just go with the pro. The pro already done their job.
Sure.
Yeah.
Just follow them, right?
Yeah.
So the next question is by Chong. In relation to the evaluation, do you consider net tangible asset when you do your stock picking evaluation?
This will be applied to different sector. So when we will only use to evaluate the net tangible asset when there is on the company that have turned around or in a loss-making company, then we will use NTA. Basically for growth or consumer staples company, we don't usually use net NTA. Yeah.
Okay. So the next question by Kok Cheng is that how do we identify dividend trap stocks?
What do you mean by dividend trap stock?
Like we want to invest because it fetches a high dividend yield, but it ends up becoming a trap, and our capital got stuck. I guess that's what Kok Cheng mean.
Usually with a high dividend yield, declining in earnings, their low debt value, free cash flow, and dividend history, unstable dividend, or they use financial leverage to issue dividend. Yeah, so this is the so-called dividend trap stock, and they didn't consistently pay out the same. For example, you can see the dividend payout from the Heineken or the Nestle or even Carlsberg, they have consistently the same payout around 90 cents every time. But there are companies that they use leverage to issue dividend, or they have a one-time off gain to issue dividend. So that will be the trap that, yeah.
Yep. So avoid companies that borrow to pay dividend. Yeah. So that's the idea that we got from Wai Ying. Kumarasan asked, the construction and property sector had a bull run this year, and there was a very strong bull run. So would your screening criteria pick up early this year?
No, because property and construction sector are more for trading than a long-term holding or investment. They are more on cyclical.
Okay, so you don't focus on cyclical stocks, but you focus on stocks that are probably trending in circular trend and that can grow substantially in the next 5 to 10 years.
Correct.
So you are more focused into growth investing than cyclical investing.
Yes, because we just want to have a peace of mind when we sleep. That's why we focus on quality business only.
Okay, of course, different investor, you may have your own preferred style. So you can just refer to what how Wai Ying does her watch list, and you can customize it and to fit into your investment style. Okay, so be it for turnaround investing, cyclical investing, or even for value investing, you just come up with your own screening criteria or fundamental criteria, so you can build a watch list that's based on your investment approach. So the next question is by Gan. Can we consider share buyback companies? I think what he means is that companies that conduct share buybacks as fundamentally strong companies.
I think most of the company in Malaysia, they don't really practice these share buybacks, except for those like Maybank or banking industry, or those company that has a stagnant growth already. Like the company that experiencing growth will not have share buybacks, as they need money to grow their business. So for share buyback, this kind of practice, it will only happen happen normally on the sector or the company itself that already have not much growth, and they prefer share buyback to reduce the liquidity of the company.
All right. Thanks so much, Wai Ying. So the next question is, how credible are the analyst rating? So what do you think?
Okay. Statistically, I think it's only around 60% chance that earnings are within the analyst expectation. Yeah. So the rest of the 40%, you have to do some homework by yourself or read as much as possible.
Correct. Always, I think I always subscribe to the belief that always take their research report with a pinch of salt, right? Because some research analysts may have blind spot. Okay, so take that as a reference. Okay, and to conduct your own due diligence. So the next question is by Edmund. Just now you have shared with us the quantitative criteria when it comes to evaluating companies and put that into a watch list. So do you analyze the qualitative aspect of it, like the mode, the economy mode that a company have to be considered in your watch list?
Yes. Except the qualitative on the mode as well, on the economic mode as well, I will try to pick the company that has the strong competitive mode. So for example, I will be picking like company like Bursa, they are the monopoly in the Malaysia market, so no one can replace them as at now. And for Heineken and Carlsberg as well. So they have a strong competitive mode with a license. Therefore, there is not much newcomers can easily come in and join in this industry or sector. This is the mode they have.
All right, so it's also part of the consideration.
Yes.
Okay. All right, so it looks like we have run out of time to do any more Q&A. So we want to thank all of you here for staying here until the end of this session. So ladies and gentlemen, you just heard from Ms. Tang Wai-yin, who is a dual license dealer representative. All right, thank you, Wai-yin.
Thank you.